Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, as always, Michael Becker.
Hey, Paul.
Michael, what's going on these days?
Well, what I'm most excited about right now is we have the Old Capital Speaker Series kicking back off again after a few month hiatus over the holidays. So the next one we're going to have coming up is going to be on February the 15th. That's February the 15th at the Grapevine Convention Center near DFW Airport. We'll have two speakers there. We're going to have, first off, David Kahn, who's the economist for CoStar, and talk about both the national market and the Texas market, specifically for the multifamily space, kind of what's going on out in the national economy and how that's affecting the apartment space. And then we're also going to have both Paul and my personal CPA, a guy named Mark Patton, come in and talk a little bit about the most recent Tax Reform Act and some of the impacts and how that's going to impact the apartment space. So that's going to be some pretty good information. That's at doors open at 6. We're going to have networking for about an hour, and the speaker series will start about 7 p.m. So we definitely encourage everyone to come out. And then the next one that we have coming up after that, because this one's going to be coming up pretty shortly after we air this podcast. After that's going to be Dr. Mark Dotzauer. Also will be at the Grapevine Convention Center on March 28th. He's going to be speaking around 7, doors open about 6. And if you guys haven't heard Dr. Dotzauer speak, he's great. I know Paul and I saw him a few years ago. I had to spend, well over $100 for a ticket to come out, and it's going to be free to come in and attend, or at least free to you.
Not free, Michael. Come on.
Subsidized by Paul Peebles to come out and hear Dr. Dotzauer speak. But in all seriousness, if you guys haven't heard him speak, he's a very entertaining, engaging speaker with a lot of good knowledge. So that'll be on March 28th. So we expect to have, probably over 400 people come out here, Dr. Mark Dotzauer, if last year is any indication. So I definitely encourage you guys to put that on a calendar and come out on March 28th. And then, like I said, the next one's on February 15th. So put that on your calendar. For more information, please go to oldcapitalpodcast.com. You can register and kind of sign up. You do need to come in and sign up for a ticket so we can, track who's coming in the door. So that'd be great.
That's some great information, Mike. Thanks for sharing the Old Capital Speaker Series, which is always a great and worthwhile event to go to. Talking about themes for 2018, biggest theme that we're kind of hitting on is women in real estate. Women in real estate. So if you're a guy listening to this podcast, maybe have your wife join you in kind of listening to this podcast. And if you're a woman just thinking about getting into multifamily real estate, maybe turn this up a little bit and listen to our guest. She's been on the show before, but I think that she is an excellent communicator in making sure that you understand a little bit how she got into the business, what she does to be successful, and she has some great tips that I think we're going to try to pull out of her and have her share with everybody on the podcast. So again, keeping with the theme of women in real estate, I want to welcome Rupa Kaskar to our podcast. And Rupa, thanks for coming back.
Thanks for having me.
So, Mike, I'm going to kick it over to you.
Yeah, Rupa, you were on, year and a half ago. So if anyone hasn't heard that, please go back in the archives and listen to that episode. I thought Rupa did a good job. But maybe for everyone's edification here, maybe you kind of just do a quick little background. Tell us a little bit about yourself, kind of what you did professionally, and then how did you get into the apartment investing space?
Yep. So I was in IT for many years. I worked for Oracle in this very building where we're doing the podcast right now.
Live to tape from Frisco, Texas here.
Yeah, it's a little bit different conversation. I was basically bored, and not because there was enough to do, but I just wasn't excited about what I was doing at the time and looking for other opportunities. Real estate came about because we were looking for ways of cutting down on taxes, of all things. So one day I was having a bad day, Googled real estate investing, found a group here locally, and went for some training and thought it was a good fit for me, my personality, and being able to do what I wanted to do.
So when was that? What year was that?
This was in 2011. I went into training in 2011 and quit my job in 2012. Started out as a passive investor. We were guarantors in somebody else's deal that Mike, you worked on that one. You also worked on my first deal, which is a tiny little 32 unit that I was scared to death of doing. I drove by the property and saw a drug deal happening in the process, just driving. Called Paul after that and said, I don't know if I should look at this property any further because there's a drug deal going on. And Paul said, well, don't worry about it. You buy the property, you turn it around, they're going to know there's a new sheriff in town.
Yeah, I always remember. So Rupa came in on a white horse one day because we had a transaction Paul and I were doing, and the sponsor of the deal just didn't have enough net worth to get me comfortable when I was working at Wells Fargo to approve the loan. So Rupa came in and solved his problem, and that was kind of her first foray into investing. So she was a guarantor on a loan, really kind of saved the day for that transaction.
That's great. Great job, Rupa.
And then she moved into, was a 32 unit deal?
32.
In Irving, Texas. So it's actually a pretty good part of town. So it just happened to be totally mismanaged, rundown property. So maybe just talk about that a little bit. So how many units have you done to date so far?
Over 1,000, including the ones that we've already sold and
Yeah, so over 1,000 units. But your first deal was a 32 unit deal in Irving, Texas. So maybe kind of just quickly go through that, and then we'll transition to what you've been up to more recently.
So the 32 unit was supposed to be a yield play by operating and cash flowing. Didn't work out that way because when we went under contract, it was 97% occupied. And then as we were getting ready to close, it was down to 90. After we closed, it kept going down, went all the way down to 63%.
Oh, wow.
And every vacant unit in a 32 unit is quite a bit of a drop. So a lot of sleepless nights because I didn't really know what I was doing. It was the first property and it was the first time I was dealing with somebody else's money. So a lot of pressure, but like you said, it was mismanaged. It was this out of town owner who had a small property management company who really was not very involved. So that was mostly an operations play. Paul did the tour with us and said, tell them what you want to do. But I did not know what that really meant at the time. So I took what the inspector said needed to be done and used that as my rehab budget. And I know we're going to talk a little bit more about the rehab on the subsequent properties, but on that one, so basically just cleaned up the tenants, got rid of the drug dealer with the shiny red car, and that was the story.
So you sold it and made a big profit?
We did sell it in 2 years and made over 100% return. I think that if I held on to it, we would have made more, but that property was just too much work for the size at that point.
Tell me a little bit about the seller in that case who was out of state on these smaller properties. How difficult is it for an out of state ownership group to manage a property and even have a on-site property management company in the area? How difficult is it?
For a small property especially, it is extra difficult because it's very difficult for you when you have a management company and an on-site property manager part-time. They're usually always looking for a full-time job that they're going to transition into. Part-time maintenance just doesn't work. It's very difficult. I live in McKinney, and I was constantly getting calls from the city. The city of Irving is very, very tough. They're pretty strict with the code enforcement. So even being in town, owning the management company, I got a lot of calls and I had to deal with it. Can't imagine an out-of-town owner having to do that. So
you would think that it would be almost damn near impossible if you're an out-of-state person with these small properties, whether it's 20 or 25 doors, even 30 doors, that it's very difficult to manage at a distance. It would be. On a larger property, it is a lot easier because the numbers tell the story. In a small property, it's not quite the same. That's true.
So you've done, near 1,000 units on buy and sell. And so what was the largest transaction you've done as far as number of units of the properties you buy? So you bought 4 to date and you're about to do your 5th one right now, right? So the largest is 327 units. So 32 units to 327. So you just 10 times the number of units. So then the property that's 10 times bigger is probably almost 10 times easier too, right? It sure is. So when was the last property that you purchased? That was in September 2016. And so we're here February of 2018, so almost 18 months later. So what you been doing the last 18 months? What's been going on? I thought we could use this subject to kind of talk, be a little more topical about what's going on in the marketplace from a real life person out there in the market trying to find deals and acquire deals. Kind of maybe talk some real talk about some of the struggles that are going on in the marketplace when you're out there trying to source some inventory. So it's been 18 months since you bought your last deal, and you just yesterday were awarded a new property to buy. Is that right?
That's correct. So while waiting, I was eating bonbons and
Sitting at home?
watching soap opera.
So in all seriousness, so maybe let's kind of talk through it. So maybe you give some stats. I know before we started recording, you kind of give me some stats. So what's been happening in the last 18 months as far as Team Rupa trying to find a deal?
Yeah, so that has been the most challenging part of real estate investing, is finding deals. When I got started, I thought I was going to get all these deals, and where was I going to get the money? It's the other way around, where there's investors pounding on your door with checks ready to go, and there's just no deals. And we're dealing with other people's money, so we're extra careful with not just buying a deal that works for us, but works for the investors. So we made a lot of offers for properties that were on the market, as well as unsolicited offers based, just going blind and making guesses about, educated guesses about what their income would be. Over 100 of offers altogether.
100 LOIs?
100 LOIs. And we toured over 40 properties. We were in best and final in about 15 of them. And we had one. We thought we had one. We were told we had one, but it was an off-market deal, and the seller, working with the investors, then came back and said they're not selling at this point.
Yeah. So you did 100 offers, toured 40 deals, gotten 15 best and finals, and now you just got awarded your first deal that hopefully is real and will close, right?
Yes.
So
We're pretty optimistic about this one. This one is a second deal that we'll do with the seller. We own in two markets right now, in Sherman and Waco. My second deal was in Sherman, and third and fourth were in Waco. And the second Waco deal, the owner also owns in Sherman.
Yeah.
So we're back to Sherman.
There you go. So let's talk about that. So you mentioned some of the struggles along the way. So you had a deal that you put an offer in on, the seller accepted the offer, and then to change his mind. Is that basically what happened?
Yeah, basically it was more of an investor that, one of the investors wasn't ready. They had done a 1031 exchange, so it would have been a taxable event for them at that point, and that wasn't something that they wanted to do.
So maybe you have any other examples? What else has been kind of frustrating? I just want to make sure everyone kind of understands these are some of the challenges out there in the marketplace. And so what are some of the other things that have happened to you along the way where you kind of got your hopes up and then ultimately ended up getting disappointed?
The biggest time that we got our hopes high up was when we were told we were the highest bidder and we were likely going to get the deal. And we didn't, because there was, I guess, I don't know what happened. There's probably some more magic happening behind the scenes, but they decided to work with someone that they had worked with before. It was a much bigger group. Our number was better, but it was a bigger group, and they decided to go with them.
So you were the high bidder, and they didn't sell to you anyways, right?
Still didn't. I felt like in Pretty Women, we had all this money. Somebody take my money.
Yeah. And what else has happened? I mean, I'm sure you said you made 15 best and finals. What are some of the other challenges you've had through some of these best and finals?
Yeah, several times we knew what the number was going to be, just having a relationship with brokers. But those numbers kept going up, and we've come to realize that, the returns are going to be lower than they were when I first started in 2013. But on my first lead deal in 2013. So we were okay with the reduced returns, but it's just been where the risks that you have to take to get the lower returns were higher. You've got value plays where the value is already priced in, as you're aware. So, we draw a line in the sand and almost have to redraw the line, which, we will go a little bit. We'll stretch our arms a little bit just to still reach the line, but won't redraw.
Got to stop at some point, right? Yeah. So that's interesting. So the first couple deals you bought to today, what's been some of the biggest observation? Obviously, competition's bigger, but for what it seems like you kind of alluded to it with your previous statement there, that any more to buy any property with the value add, you're having to overpay for that property by quite a bit and really give a good portion of your upside to the seller just to have the opportunity to buy a value add deal. Is that kind of what you're seeing?
And the number of offers that you're seeing, I think the first one, there were 8 offers and they took ours. I think the same property probably have 20 today.
Yeah, Mike, are you seeing that in the Class C properties where the cap rates are actually more compressed than the Bs?
Yeah, it just seems like kind of, I talk about this all the time, but a little history lesson, 5 years or so ago when Rupert and I both were kind of buying deals around the same time. We started around the same time. You look in Dallas Fort Worth and you see a brand new Class A deal would be about a 5 cap and a C deal would be 8.5 or 9. Flash forward to today and the A properties are 4.5 and the C properties are 6 or maybe lower, even. And that's really the big spread between it seems to be a little bit out of whack where the C stuff is just over, because it has the value add story. You having to overpay to have the opportunity to go out and implement your value add plan and go capture future revenue.
And then coming back to Rupa, you've purchased properties in Sherman, you've purchased properties in Waco, and you've purchased properties in Irving. Irving is kind of the center of the universe in terms of between Dallas and Fort Worth, but Waco is about 90 miles or so?
Yeah.
Plus, and Sherman is probably about 50 miles or so?
From Dallas.
From Dallas, so it's kind of a tertiary, secondary market. Are you seeing, cap rates higher in those secondary, tertiary markets, or are they coming up and almost being the same as Dallas?
Yeah, almost. The price per door is lower, but cap rates just as crazy there too.
Just crazy. And then let's kind of go back just to kind of establish. You went to school up in Minnesota.
I did. Feels like we're in Minnesota today.
It is. It's a little chilly today. And so you got specific education to work for one of the largest companies in the world. And now you got specific education on multifamily. How important having a mentor or a group of people that help you to buy multifamily, how important is that?
Well, I knew nothing about multifamily when I started. So to me, it was very important because, like I said, I didn't know what I was doing. I made plenty of calls and getting help. What makes a good deal? I would have walked away from that first deal because I saw a drug deal happening, but you convinced me that was the right deal to do. So more than mentors, there's the network of people. And I want to say something, Paul. You didn't tell me to say this, but I know a lot of times people just go for the best rates. They're looking for the best deal. I know several times you have asked me to walk away from certain deals, and that's why I work with you, because when you tell me something is a good deal, it is going to be a good deal, and it has worked out.
Thank you. So. It's an unsolicited comment, so thank you very much. But in specific areas, you need specific education, and this is one of the things that I definitely think you need specific education, because you may join a mentoring group that may not have ecosystem, and the ecosystem that you're part of has the ability not only to educate and mentor people, but also kind of help you find equity in transactions too. So that's an important thing. Wouldn't you agree?
Very much so. My first deal, it was just me and 3 other investors. My husband and I owned 57% of that first one. And I'm not a salesperson, so I'm not the one to go up there and talk to someone and say, hey, do you want to be in my deal and try to raise $1 million on my first deal. That's just not my personality. But I can today raise $4 million in a couple of hours.
Isn't that amazing?
It is fantastic.
Let's go. You talked about your husband, super nice guy, and I've known him for a long period of time. But what type of an involvement does Nitin have in this real estate investing?
My husband is a super smart guy, too. He's
He's
the brainiac in the family. He has a PhD in chemical engineering. He works for Cisco now. He does really well. So when we first got started, he's very good with rules of thumbs and the high-level thinking. But, he's a geek, and he tends to forget certain things. So this is really a better fit for me. So it is mostly men in this business, but I think you really need to see who is a better fit in your family for doing something like this and not worry about the gender.
Yeah, I definitely agree. I think Nitin is good at what he does, and I think you're tremendously successful because you're tremendously talented in this multifamily business. So it's probably better for Nitin to remain a PhD doing his chemical engineering, and it's very good for you to stay with your multifamily business.
I'm down in the weeds and he's up in the clouds.
You are definitely down in the weeds. We talked a little bit about what Mike did is, you've been thinking about trying to buy a property for the last 18 months. What has changed in terms of expectations for rates of return to limited partners? What are they looking for right now in terms of a rate of return?
When I started, it was double-digit cash on cash.
Right.
Usually was the expectation, especially for a Class C. Now, my expectation is to get 7+ cash on cash return and then double your money in about 5 years. But my investors come to me all the time, so our money's just sitting there. If you give us like 6, we'll be happy. It's much better than what it is with the bank, obviously, and a lot more predictable than what is in the stock market.
Yeah, talking about predictability, I mean, you have a big position in stocks right now. How would you like to be in having some of these pullbacks? I know you were a little bit worried about your stock portfolio, but you're not so much worried about your real estate portfolio.
On down days when the market's down majorly, I kind of put my blinders on. That's when I go shopping for stocks, right? I don't go to the mall. I can get whatever I want from Amazon, but on a down day, I do still go shopping for stocks, but I put blinders on and not look at how much it has gone down for that day. But if there's something that I want to buy, I go and log in to do that. It's not all that different in real estate because you still have to put your blinders on. Everything is overpriced, but you have to just evaluate each deal on its own, and eventually you'll find one that works.
That's good. So this is your 6th year now in full-time real estate investing here. So you're doing your 5th deal as we speak right now, and you've sold a few, and so you've kind of got some lessons learned, I'm sure, along the way. So if I'm an aspiring first-time apartment syndicator, we get that question all the time, like how did I get started? So I think we've touched on that many times about getting specific education, but now kind of reflecting back from, Rupa of 6 years ago to today, what are some of the things that you would tell yourself now, or some like the lessons you learned along the way that you can maybe share with the group so people can kind of keep these in mind when they're doing their deals?
Yeah. So the first thing is raise more capital than you think you need. On my first one, like I said earlier, we went with what the inspection report said and raised enough and a little bit more for operations. Worked out great, worked out very well, but it could have been even better because on my second one, having learned from that, we needed about 1.1 million. We raised 1.25, so we had a lot of cash sitting around, which gives us the flexibility to do more than what we intended when things are going better. So that's the first thing.
Let me echo that too. That's been, I've been fortunate enough to never make any sort of major fatal mistakes, but every time I've made a mistake, it's been coming in a little short on capital. It just makes everything hard. Just makes your ability to start projects harder. Once you get in these deals and you figure out what's working well, like, oh crap, I should have raised money to do X, Y, or Z, or more units or something different. So I think just having some more cash on hand is certainly a good piece of advice.
That's a little bit like the Becker's theory of how deals go bad, of not being undercapitalized. And why these transactions went bad 7, 8 or 9 years ago.
10 years ago now.
10 years ago. Yeah. They went bad because people didn't have enough money.
Yeah. So raise extra. I just want to drive that point home. I fully agree with Rupa.
Yeah. And then raising capital is the easy part. That's what I learned. Once you do a couple, you put yourself in your investor's position. What would you want to know? And you stay on top of things, communicate, and raising capital becomes very easy. Back to the raising capital, sometimes it's okay to go over budget. We certainly did in a couple of areas. The swimming pool was worse off than what we thought it was going to be, and we decided to bite the bullet and go over budget. But we never have to do any more maintenance on that for a long time because it's a brand new decking and new equipment. And we went over budget on the interior rehab because we were able to raise rents further. So it's okay to go over budget. This one, I know a lot of my investors give me a hard time about. Don't distribute all your cash flow. As soon as you start having, we hold back quite a bit just because you never know what the market's going to do.
Mike, put your banker's hat on again.
Yes, I agree with that too. Because then once you start setting out expectation levels at a certain level, it's hard to go backwards or cut it off because you're like, crap, the boiler went out and I need $20,000 to put a new boiler in, and I don't have that money because I gave all of my free cash flow back out and I didn't raise enough money on the front end. So those are just very important. So if you're going to be free cash flow of an 8, maybe you distribute a 6 and keep that 2% back until you accumulate some, proper reserves of some unneeded working capital. Definitely agree with that one too.
And then have a vision for your property and budget according to that. So back to what we were talking about earlier in terms of taking the inspection report, that's just the physical aspect of it. But you really need to have a vision for the physical aspect of it as well as how you want to run the property. For our Waco property, that's 327 units. We wanted sort of a resort feel to it. And, the pool had to have certain features. We have those lounge chairs, the swing lounge chairs, just color-wise, design. We actually ended up hiring a designer because...
Tell us a little bit about that, and did that work out well?
There are two aspects of it. The exterior design, we hired a color designer. That's all they do, design color, and that worked out.
For painting the property for a certain color?
Yes.
And why is that important?
So when we first started talking to a contractor, we said, we want a pop of color. We want to put some trim, but we're going to leave the rest of it okay. And he said, okay, if that's what you want to do, that's fine. But if it was me, it was my property, I'm driving down the road and all these properties are beige and your property is beige. If it was me, I would change the basic color as well. So we said, well, give us a price both ways. Along the way, somebody recommended a color designer. If you go to our website for this property, is liveatavila.com. I'll give my contact information later to look at it. We have orange and blue and grays and pop of color. So it's a noticeable property. When we first looked at this, we looked at the property across the street and said, we want to be like them. And now we go there and go, they're so beige and boring.
What do you think that's done to your bottom line to have a property that pops?
It certainly brings people in. You get started, and when we bought the property, it was at 90%. We went up all the way up to 98%. So it certainly brought people in. So the color designer not only just picks your color, but they give you a drawing of the different buildings in different areas and different colors. So it makes your life easier when you're working with a contractor. You just give the specification, the full everything is decided, so you're not getting calls in the middle of a project saying, hey, what did you want to do with this door? What do you want to do with trim? Or what do you want to do with...
Is that a separate company that does that, or is that part of the painting, the people that provide the paints? I mean, who pays that person's fee to come out and take a look at your property?
In this case, we did.
Okay.
I think they have some programs where someone else, Big Show is Color Design LLC. Mm-hmm. So that worked out really well from choosing the colors and design. The interior design, I found that it was very slow process for me. So interior design from now on, I took some classes.
Oh, good. And now you guys had an old tennis court on that property?
Yes.
And what did you do with that? Because are people playing tennis these days?
No. I haven't seen anyone.
Yeah, Mike.
Maybe the Peoples play tennis, but I don't know if anyone else.
No, we don't play tennis anymore. But these tennis courts were very popular back in the 1980s, the late 70s, early 80s, when these properties were built. And they've been just sitting, vacant, decaying
in the middle of the property.
In the middle of the property, so it becomes really an eyesore to the tenants in the property. So, what did you guys do with this, and where did you get the idea?
We turned it into a courtyard, basically. A couple of grills, very nice grills. A couple of cornhole games, those kind of games. We had a bunch of lounging area, just a place for people to gather. We call it the square.
So people like that just due to the fact that it becomes a sense of community on the property. And so, Mike, you've done that in a couple of your
Yeah, we
properties.
took one of them out actually before, and that was then replaced it with sand volleyball, a dog park, grilling station, cornhole, outdoor ping pong. So we can spend all sorts of money doing stuff. But yeah, it's been great if you have the capital budget and the vision to go ahead and take it out and really make it like a centerpiece of the property. Because more than people, I'm sure people use it, but more than that, if that's strategically between your office and your model unit, and that's your main amenity set. So when people are doing the kind of the lease tour, that's kind of what they see, and they envision their lifestyle and how they're going to use these amenities and use the gym and save $20 a month for 24-hour fitness or whatever. And, I don't know if anyone actually uses the gyms at these places, but they think they will. And it's most important when they're actually making the leasing decision.
When you guys put that together, what did that cost you?
That was not the highest item on budget. It was about $30,000.
You put money aside. You brought that money to the table. You didn't try to take it out of cash flow.
No, we did not. We had planned on that. A couple of things I want to touch on. Mike, you said fitness room. We actually got rid of our fitness room because it was a very sad looking one that I don't think anybody would have used, as you said.
It's so to get not to get too deep in the weeds, but it depends on the class of the property, right? So if you have a C-class property and a lot of your tenant profile works, blue collar jobs, and they go do physical stuff all day, none of those guys want to go to the gym.
Yeah.
Guys like Paul and I that sit behind a desk all day, then we need to go to the gym because we're not getting any workout. So it kind of really depends on your class of your profile.
But what we did with this though is what Paul talked about, which is we turned it into a community center. We did not have one, so that was going to your point, we talked to our property manager and asked what would work better, and the community center was what they felt. And part of the value play when we're looking at properties, we're not just looking at physical aspect. When we tour the property, we ask what kind of community events they have, and when they don't, we consider that as value play. Our team does a great job at all of the properties in doing community events. And if you go to our websites, we have great reviews, and that works wonderfully, especially when people are moving out of town and looking for a place. They do want that sense of community.
Mike, going back, say this property has a 98% occupancy. What should occupancy be? There's kind of bells and whistles you have to pull here and there.
All things being equal,
should
I
it be
think
that high, or should you start raising
the perfect
rents?
occupancy is about 95%. So that means that you're full and you're capturing most of it, but at the same time you're in the process of pushing rental rates high, so you're causing some sort of churn in and out. So if you're asking me, the ideal occupancy is about 95%, because it means if it's 98 on average fully all the time, it means your rents are too low.
Yeah, that's.
But at certain points in time, you could spike up and you could dip down. But all in all, if you could strive to be about 95%, I think that's the right occupancy.
That's good. Let's go back to Rupa's lessons.
Yeah. So the final thing I was going to say is, even when you have a management company, you have to manage the management company. It's your property. You're in charge of the investment, and you make sure that they're delivering to your objectives, and be a good owner. You can't just expect without giving. You want good results, but you're not willing to put any money into a property. That's not realistic.
One of the things I think you do a good job, you have pretty loyal investors and people that are really big fans of Rupa and your team. I think one of the things you do well is communicate. Once you own the deal, you communicate on a frequent basis. So I don't know if you want to expound upon that subject matter a little bit.
Yeah, I used to be a consultant when I was an IT consultant, and the lesson I learned was stay one chapter ahead of the client, because as a consultant, you have to anticipate what your clients are going to ask. So as the lead investor, as a sponsor, you know what kind of questions you should anticipate, what kind of questions they're going to ask. So we communicate up front. I get a lot of people who tell me I would never want to be a sponsor. I see how, this person gets so many questions, and well, it's a fair question. I would want to know. I'm very detail oriented. I want to know everything that's going on. So just put yourself in the investor's position and
try to anticipate and communicate ahead of their questions that should be coming.
Are you putting out a monthly or quarterly communication, whether it's the operating statement, coming from the management company, or are you breaking things down about, we're replacing a fence over here? How detailed should you get?
We send monthly reports, but we don't just take what the management company sends and just, forward it over to our investors. We add color commentary on top of that in terms of some of those items are, we do the asset management. So items that the management company is not going to be talking about, but people just like to know what's going on in addition. So we have quite a bit of detail, but sometimes I know that our investors don't read everything as they read when they want it.
Some do, some don't, right?
Yeah.
So speaking of that, I know you had, something else. I know you gave a presentation for some of your investors, kind of some like do's and don'ts, I think you had. So kind of maybe continuing on, do you have any sort of things that you like to do and things that you don't like to do along the way, or any kind of further advice that you would give yourself from 6 years ago, that lessons learned along the way?
Yeah. So as you know, I came from a corporate world. So what I like in this field more than the other is flexibility. If I have something going on, my husband's traveling right now, and
you guys have 2 kids.
We have 2 kids. One's driving, so that's helpful.
That's good.
But I have a lot of flexibility. I can go back to work at night if I need to take my son to a dentist appointment in a little while here, or I can just do. And the other thing is, there's a lot of variety in what I do. There's analyzing, looking for deals, touring deals, contract when you're getting ready to do a deal, putting all the legal paperwork together, design, which is a lot of fun, operations. I'm looking at water signal charts and wondering why the water bill suddenly went up so much. No one raised that question. And then I have control over the numbers. I'm a very competitive person. I'm competitive with myself, which is, we did, 8% this month, this year, cash over cash. And now we have to do better than that. But having complete control over numbers is fun.
What don't you like about being in this position?
It always seems like I'm going under contract when I have vacation plans. I sold one when we were cruising in Europe. I signed a contract to purchase one when we were in Bali. And, the timing's always...
I think you travel too much, maybe. Yeah?
Well, that's why I got to this business, right?
That's right.
Flexibility.
That's right. Flexibility. So... Cool. Paul, do we have anything else kind of to wrap up? You've known Rupert longer than I have. I know we've both known her a long time now, but it's been pretty impressive from afar to watch you grow in this business and go from, coming in and signing that first note and doing the little 32-unit deal to kind of now you're buying deals 10 times as large. One thing I took away from our conversation, and, one of the things hopefully the listeners will take away is that, there's going to be some challenges along the way, especially when you're trying to find a deal. It's about being persistent and consistent, but, at the same time, maintaining your discipline on, return requirements. And you're going to have to kind of beat your head against the wall sometimes along the way to get there. But if you, done correctly and you keep a good attitude, this can be done, and you can achieve it and buy, over 1,000 units like Rupa has.
There's no doubt about that. You may have to kiss 1,000 frogs, or in this case, 100 LOI, apartment building LOIs, given the kiss, and define the prince or princess in some deal. But you just can't give up. You just have to, you got to keep on going. You have the vision. Again, women in this business, I think you pointed out a couple things, can become a designer, putting your hat on and trying to put the buildings together. Gives you some incredible flexibility of your time on the deal, so you can do other things besides being an apartment owner. But and then you can partner up with other people too. So if you're a good communicator, and that's what you've done, and you've partnered up with folks.
Yeah, and you mentioned, Paul, for men who are listening, you have a very important role, even if it's the woman in the family who's doing investing, because you have to be supportive. When I am in the middle of a deal, Nathan takes care of the kids, the cooking, the house, whatever it is, whatever needs to be done. So I certainly cannot do it by myself. A lot of times I have guys who say, I wish I had the time. Well, what about your wife? Just encourage them to do it. And
I think that's the biggest thing is this is kind of a team sport. If it's not you, let's have your wife get into it and start running it. If it's not you, get your husband into it, and get it together, get on the same page.
Absolutely.
So again, Rupa, we appreciate you coming in and giving us some pointers about what's going on. Congratulations on your new transaction coming up.
Yeah, definitely appreciate you coming in. Maybe if people want to find out more information about you or maybe reach out and ask you some questions, what's the best way to reach you?
They can go to our website at www.prasiti.com. That's P as in Paul, R-A-S as in Sam, I-T-I.com, prasiti.com.
And again, I want to make sure I encourage everyone, if you guys are interested, you want to get out and get networked and meet people, and I'm sure Rupa will hopefully be there as well. We do have the Old Capital Speaker Series coming up again. February 15th is the next one, and then the one following that's going to March 28th, both at the Grapevine Convention Center. Networking, both times start around 6 o'clock, and the speakers start around 7.
That sounds great. Rupa Kaskar, we appreciate you being in the podcast today. Michael Becker, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.